Hello everyone. Thank you for the opportunity to present my findings based on a comprehensive financial review of Apple over the past 5 years ending in fiscal 2024. I will focus on key trends in profitability, capital allocation, valuation, and the current financial positioning. Apple operates in 5 business segments, with iPhone sales and services such as App Store, licensing, and iCloud contributing to more than 75% of Apple's total revenue. North America and Europe contribute to nearly 70% of Apple's top line. Over the past 5 years, Apple has maintained a resilient revenue base, mostly flat around $380 billion, despite macroeconomic volatility. The net profit margin remains stable at around 24%, demonstrating strong operational efficiency, even as the tax rate nearly doubled to 28%. Gross margin improved due to a structural decline in cost of sales from 62% to 54% of revenue. Segment-wise, services revenue grew at a compounded annual growth rate of 15.5% with a 74% gross margin, and which is double the growth and margin from products. Bottom line is that services are growing twice as fast as products. Apple's revenue per employee of 2.4 million reflects superior workforce productivity and a lean structure. Apple's capital allocation strategy has delivered consistent value. Earnings per share has doubled to $6 despite flat net income, driven by aggressive share repurchases. The dividend payout ratio declined by 33% to the current 16%, preserving cash for flexibility while maintaining shareholder returns. While these percentages are lower compared to industry peers, Apple generates over $100 billion in annual free cash flow with a sustained margin of 25%, which is well over industry average. The company returned a total of $481 billion to shareholders in the last 5 years with a buyback yield of 2.6%, highlighting discipline and a strong capital utilization plan. Apple's 2024 ROE stands at 157%, driven less by income growth and more by capital structure optimization. Net profit margin remains stable around 24%, while asset turnover is slightly over 1, confirms operational asset efficiency. A high equity multiplier of 6 reflects extensive share repurchases, which amplify the ROE by equity reduction, while net income remained flat. While this capital structure enhances returns, it introduces high sensitivity to earnings and makes the leverage component the most volatile factor among the drivers of ROE. Apple deliberately maintains a lean liquidity position for short-term solvency with a current ratio less than 1, enabled by highly predictable cash flows and a tight working capital. Financial leverage or debt to equity ratio is high at over 5, but is strategic. Apple uses low-cost debt to fund dividends and buybacks, preserving global cash reserves. With more than $150 billion in cash and marketable securities and a top-tier credit rating, Apple remains financially flexible. Apple doesn't borrow because it needs cash. It borrows because it's cheaper to borrow than to use its own capital, especially for shareholder returns. Apple's stock price has appreciated 4 times since 2020, while earnings per share has only doubled, resulting in a significant value expansion of 120%. Price to earnings ratio more than doubled to 38 despite flat net income growth. The stock trades at 26 times EBITDA, which is both higher than its own historical average and the industry median. All these factors indicate a premium valuation and a high investor confidence in Apple's future monetization potential. But is the current price of $197 justified? Based on my calculations, the dividend discount model significantly undervalues the stock at $40 due to Apple's low dividend yield and aggressive share buybacks. Discounted cash flow model valuation is more appropriate for Apple's strategy and reveals that the stock is undervalued by 20%. In summary, Apple's financial foundation is robust. Apple consistently converts around 25% of revenue into free cash flow, enabling it to support continued innovation and capital returns without strain. The company's dual engine structure, where products drive global scale and services generate 40% of gross profit, ensure both reach and margin stability. Apple has maintained stable ROA around 25 to 28% through inflation, supply chain shocks, and foreign exchange headwinds, demonstrating executional discipline as well. However, there are a few risks to consider going forward. ROA is increasingly becoming sensitive to net income changes due to equity reduction from buybacks. The effective tax rate has nearly doubled, suppressing bottom line growth. Regional risks, particularly in Greater China, and intensifying AI competition across the globe are key watch points. Finally, my strategic recommendation is to accelerate AI integration across Apple's ecosystem of more than 2 billion devices and monetize the high-margin services segment with new services to drive sustained growth. Thank you, and I can take any questions or comments you may have.